Hey, Matt Hullander here. I've got Garnett Decosimo with me. And when I sold my business, there were things I didn't know. And going through that process, I realized how important it would be if I had somebody walking along with me through that sale. And now I would like to help other home service business owners do the same thing. And we're going to talk about it today.
Matt, happy to be here. Looking forward to the conversation.
So Garnett, for those that are listening or watching today, give us Decosimo's background. V2 Strategy Advisors, I'd been consulting with companies and realized the need to help sellers. And I realized a lot of them, I guess, didn't know what they didn't know. And our families have known each other for a while, and I think it just made a lot of sense. But tell me about Decosimo's history and then your role there.
Sure. So, we started, my grandfather started the accounting firm here in Chattanooga, going on 50 years ago. And we've been working with, and I say we, I haven't been around 50 years, but we've been working with family businesses in the area, from kind of just founder-owned businesses all the way up to businesses that have been taken public in the area, for all that time, really helping to provide audit, tax, and advisory services. But really the perspective that my grandfather and the partners that he had around him, was to provide as much value to his clients as possible, which meant leveraging all of the expertise that they had built over all those decades to help business owners, manage and understand strategy and make decisions in a way that, a lot of CPAs often don't feel like it's their role to. And so I think that approach of trying to add value, trying to be a trusted advisor, really led us into this world where we're in now, which is really investment banking, but sell-side advisory, which means we're trying to help business owners, founders, or second and third generation who are trying to figure out what the next step for their business is going to be, how they're going to manage that transition, which often ends up in a sale, as you know. So we had started doing that within the accounting firm. There was a merger, and afterwards, my dad took the business, the broker-dealer that we held our licenses, and set up an independent proprietary bank, which is Decosimo Corporate Finance. And so since then, we've continued that legacy on of working with founder-owned and family-owned businesses and helping them transition in the next step.
Let's hit on that a little more and you and I have mentioned there's not a great term for what you all do. You've mentioned broker, manager, and investment banker and sell-side advisory, but really what it means let's just pick one home service business owner. And for me, it means we walk alongside them through that trend. My first home service business, I didn't really have anyone helping me. And let's talk about a few of the advantages to having somebody representing you on the sales side.
Yeah, well, as you know, there are a lot of business owners who spend their entire career building one business. And so they will maybe have one transaction in their whole career. So they're really good at what they do, but they don't have a lot of experience in actually transacting when it comes to selling or buying a business. So what you have to understand, and you've seen this, the folks that are out there buying businesses, whether services businesses or manufacturers, are very sophisticated. They do this every day. They know how to transact. And so you are, as a business owner, often at a disadvantage because you don't have that experience. And so it's really critical to have somebody by your side guiding you through that process who can look out for your interests, argue on your behalf, negotiate on your behalf, and help you navigate all the complexities that come with, getting an LOI, signing that, getting through diligence, and then making sure that the purchase agreement agrees with everything that you've already negotiated throughout that process.
And I wouldn't do it again without help. And that's why I want to help other home service business owners that are out there. And that's my old industry. But tell us, what type businesses has Decosimo worked with in the past? And then does it really matter? I know y'all understand service and manufacturing, and there's a multitude of businesses out there. And I know the process is probably similar, but there's different multiples and sometimes, and I do want to get into, how private equity fits into all this, but who is your customer typically?
Yeah, like I said, our customer tends to be founders or family-owned businesses, and that can span from services to manufacturing to food and beverage, distribution. We really cut our teeth in the Coca-Cola bottling roll-ups, doing a lot of buy-side work there. And then have worked with MLB teams as well. So really run the gamut. But, as you mentioned, the process tends to be the process, which is trying to position a business as well as possible to demonstrate its value to the right buyers, and then finding the right buyers, bringing them to the table, and making sure that they know that there's a competitive process in place, so they're going to pay top dollar. The problem that a lot of folks run into is that they'll be approached by some buyer, whether it's private equity or a competitor or someone like that, who's going to throw a decent number in front of them, sounds compelling, and then all of a sudden you've signed an LOI and you realize, maybe I could have gotten a lot more if I'd have run a broader process.
I understand that. Now let's talk about what some people might say is the sales cycle, or when is the right time to sell, because I guess conversely, you could have someone that keeps waiting on that big number and it passes them by. So in our or my industry, home services, what do you see, and typically how long are these buying cycles, and can it pass you by?
Anyone's going to tell you when you're investing, try not to time the market, because there's really no way to do it. You can get lucky, but having skill around that can be a little bit more difficult. I think knowing when the right time to sell a business is a very personal decision. It's kind of where are you in your life personally? Are you still enjoying running the business? Is this the right thing for you to do? Now, there are also up cycles and down cycles. They're good times for your business to sell. You don't want to sell when your sales are cratering. So you want to be in a strong position to do it.
Well, and I think equally it's important as to who you sell to and who the buyer is, and that can be personal as well. Are you selling to private equity, and what are they going to do with your business? Are you going to stay or not? Let's talk about what a seller's potential options would be, and I know there's many. Let's hit on the top 3 or 4.
It also depends on the type of business that you have, right? How critical are you to that business operating day to day? There's some people who are skilled operators and they're still out in the field, or they hold and manage all of those key relationships with their clients. And if they were to leave, all of a sudden, all those relationships are gone. In those cases, your options might be a little bit more limited, because the buyer's going to say, hey, I need you to stick around, because if you leave, what do I have?
Right.
On the other hand, if you've got a business that's well established, you've really built a strong management team around you who manage those relationships, who manage your folks out in the field or the manufacturing floor, then you have more options to kind of step away, and maybe you can serve in an advisory role or something of that sort. But that gives you a little bit more optionality than if you really are the key individual in maintaining that business.
So Decosimo's been doing this a long time. I think you mentioned y'all had helped with over $17 billion worth of transactions, and the reason I wanted to partner up with you guys is to give the potential seller more options, and y'all have those relationships with private equity. I think a lot of folks think, well, it has to be a replacement window business or a roofing company, but there's fence companies and pest control and landscaping and so many. I think there's 2.5 million home service businesses in the United States. And I think Decosimo having all those relationships is helpful, because you're going to bring options to the seller. Hit on that.
Yeah, well, I mean, you mentioned it when you said there are 2.5 million of these businesses out there. There's a lot of interest because these are fragmented markets. And so there are a lot of buyers, very large, all the way down to independent sponsors who are essentially just individuals who are raising capital to go out and find a business to run. And there are a lot of roll-up strategies behind that, where folks are saying, hey, we've got a fragmented marketplace. We can come in, leverage some operational expertise, particularly in the back office, create, hate to use the term synergies, but that's what they're looking to do. And so that's where you do see a lot of interest, whether it is roofing, window replacement, just HVAC services. All of those are very attractive to a lot of buyers right now.
The question I get the most often is, what can I do to prepare for the sale? And I know some people may be 3 years away, some may be ready in 3 months. Before we get into how long does the actually selling process take, what are some things that, and I got a few opinions here too, of what the seller can be doing now before they hire somebody like us to help them?
Look, it's never too early to start thinking about it.
Right. I've always said that. Act like you're going to do it. If it's 10 years from now, you're going to become a better business because you're putting systems in place.
That's right. And day to day, you can be making a great living out of a company. But that doesn't necessarily mean that you are positioning it in a way that's going to actually provide you value upon an exit, right? And it kind of goes back to what we were talking about earlier with, how critical are you to that business? How are you positioning yourself? If you've got a business that doesn't rely on you so much, there's a lot of value in that potentially. There's also, considerations about just your goals as a business owner. A lot of people that we work with, the only financial statement they produce is a tax return. And when you're filing your tax return, what are you thinking about? You're thinking about, how do I minimize my profitability so I can minimize my tax liability? But if you're running a business, you tend to focus on the bottom line where you want to maximize profitability. So you got to have a bit of a shift in mindset of how, what your goals are as a business owner. And it's also thinking about, maybe you've got one customer that, you just kill it with. And we see this a lot with manufacturing, particularly contract manufacturing. Well, a buyer's going to look at that and say, there's a lot of risk. If we lose that relationship, we're going to be in a pretty big hole. So if you've got this time, if you've got, 1 year, 2 year, 3 years, start thinking about, how do you diversify your customer base? How do you, if you're in the services installation space, are there opportunities to build in greater recurring revenue, more services contracts where you can see, more consistency in your sales cycle, more recurring business with the same customers over time? There's a lot that you can do if you start thinking about, what is it that I can do to set up a business that's going to be very valuable for somebody else?
Well, and I recognize a lot of those things, and there's a lot of home service businesses doing that really well. They've got their systems in place. They use a great CRM. They've got what I say is a good number two, because sometimes if the owner wants to exit, in the next year or 2 or 3 or immediately, there's got to be somebody that's a good number two there. I think the one I see most often where they fail is having good and accurate financials, which you just mentioned, which leads me into EBITDA. And I'm surprised. I just met with a contractor from Tennessee that didn't know what EBITDA meant. So let's hit on that. And, you can Google it, but it's earnings before interest, taxes, depreciation, and amortization. To me, that means, to some people, it only means profit. But those owners do get to add back potentially sometimes their salary and their expenses, which can grow EBITDA. And sometimes I think their EBITDA is greater than they think it may be.
Yeah. So, the EBITDA is the number, a lot of buyers are going to look at when they're trying to figure out and communicate evaluation. I would always assume, there's a lot of discussion about EBITDA and EBITDA multiples. Our assumption, it tends to be that those are shorthand for a lot more modeling work that's going on behind the scenes with the buyer, but that's how they're going to communicate the valuation to you. That's all, it's really important in understanding the way they're approaching it. As far as add backs go, that's something that we work very closely with clients on, because when you have a business that you've run personally for a very long time, there could be certain expenditures that you're running through the business that
the new company wouldn't need.
Right. Yeah. Do you have a sibling that's on the payroll that, might not be doing all that much, but, their payroll is pretty substantial? Well, you can add that back because they're likely not going to continue with the business going forward. I will say, though, and this kind of gets back to the importance of, to the extent you can professionalize some operations, add backs are great. But add backs are a fight, right? Because buyers are going to look at that and they're going to say, well, I want to know more about this. I don't really buy your assumption here, so I'm going to dial that add back a little bit more because we're not going to give you full credit for it. And you also have to understand that some buyers too are going to look at a business and they're going to have their own sort of adjustments to EBITDA that might go in the other direction, not necessarily benefiting you based on costs and expenditures they expect that they're going to have to incur as well.
Well, and I see that a lot because there's a lot of things that can affect EBITDA in a positive or negative way. For example, if you own your own property and you rent, if you jack your rent up that you're paying yourself, that affects EBITDA and vice versa. So that affects your number, and you got to look at both. I know I've heard your father talk about he's got his big three, but let's talk about, I know EBITDA would be one, which is, probably one of the leading factors. There's also risk, which you mentioned. what other things would private equity or any buyer look at aside from those two when they value what a company's worth?
Yeah. So, like you said, they're looking at risk. They're also looking at what is the growth potential of this business, right? If you're kind of steady state, there's not a whole lot of opportunity to grow, but you're generating great cash flow. Well, it's great business, but you might not see quite the same multiple as you would if they saw some significant opportunity to bring in new customers or to really grow the business in the bottom line. If you have a single large customer, they're going to view that as a significant risk, and they might ding your EBITDA or your multiple as well because they see that as a risk too moving forward. So there's a lot of kind of factors that they're going to communicate their view of the opportunity to grow, the amount of risk that's there, and generally their understanding of the industry too. There's certain things that are going to be factored in evaluation that you can't control, but are going to be just kind of indicative of the industry that you're in.
So if somebody wants to know what can they be doing now that would increase their value, and I'm going to go back to my top few, which would be, do you have a good number two? Have you been acting that way, just, like a franchise or like the book, The E-Mess says, to be profitable, which will be important. I had moved into another market before my transaction, so that helped because there was more customers to service. But what things come to mind that somebody could increase their value by doing now before they get ready to sell?
Yeah, I think certainly, again, going back to thinking about your customer mix, thinking about the team that you've got behind you. What are your revenue streams that maybe, again, you can find more recurring opportunities? If you're doing the HVAC installation, can you also get the maintenance contract on the back end? And I think, you mentioned it as well. It's great if you can find and improve your financial reporting. The gold standard is going to be the audit, right? Not everybody needs an audit.
Sure.
The value that's going to provide, particularly if you don't have a bank and you're not borrowing, or some other requirement that would necessitate an audit, you don't necessarily need to have it. But the processes that you go through to prepare for one are always going to be very helpful. I would also add to that that when you clean up and you professionalize your back office and you really get your books good, you're going to have a lot more visibility into your own profitability. We work with a lot of manufacturers, and they spend a lot of time tracking their materials costs, but they don't go so deep into tracking their labor cost. And labor, as we all know, is a significant portion of your cost of goods sold. And so it's really surprising to us when, we see very successful businesses who aren't tracking their labor. They may implement an ERP system and they see where there's some really significant inefficiencies, or maybe they're producing items that they thought they were making a lot of money on, but in fact, because of some of that labor spend that's on it or some inefficiencies that are there, they realize that, hey, that SKU actually is not making us as much money and we should focus elsewhere. So it gives you an ability to run your business in a way that maybe you wouldn't have otherwise, because you've thought a little bit more about the accounting work. And accounting, I think, particularly entrepreneurs, that's going to sound pretty boring, but it really gives you a stronger ability to manage your costs, manage your spend, and understand where your money's flowing through the business.
Well, and you hit on that earlier. A lot of these folks, they don't want to pay a lot of taxes, so they might think, hey, I'm going to go buy a new pickup truck or a few new pickup trucks for their home service business. And I've heard of some private equity groups might look at a trailing 12. Some might go back as far as 3 or more years. Is it just all over the board, or what do you typically see?
Yeah, looking back 3 or more years is really going to give a perspective of kind of the durability of your growth and your earnings, right? I mean, we just came out of COVID, and a lot of people had...
Especially in the home service business. They did well for a year or two.
Exactly. And we saw it on the manufacturing side as well. And so you saw a significant COVID bump. So people are going to want to look back, and now we're doesn't feel like we're that far away from it. We're 5 years out now. So we see a lot of normalization now. But they're going to look further back to see the durability of your earnings and kind of to help support your growth forecast that you might provide to them. They're going to look at your trailing 12 perhaps more to really kind of get that EBITDA number that they're going to base the valuation on.
Okay.
So these are your last 12 months, the trailing 12. you'll set kind of a bogey. You'll either say it at the time that you produce the materials and we start the discussion, or we'll say, we're going to look at your trailing 12 at the time that we execute an LOI. That's all part of the negotiation. But that's kind of that near term. What have you done in the last 12 months, the last year? And that's what we're going to value on.
All right, let's talk about the timeline. You said the LOI. So, well, we can talk about the process and the timeline. I've seen some, and they were more simple businesses, maybe a smaller pest control business that could close in 3 or 4 months or even sooner, where some might take a year or longer. In a general sense, what is the time frame? And I know home services may be easier than you selling a Coca-Cola bottling plant or a Major League Baseball team. But not only how long does it typically take, but can you hit on the high points along the way of what will happen?
Yeah. And just to kind of answer the initial timing, high level, we've always kind of said, expect 9 months from start to finish.
Okay.
I would actually update that now, particularly since we've kind of entered this new cycle where we've got higher interest rates, underwriting's a little bit more difficult, where we've seen that process extend out to maybe 12 months. I've seen it even go further than that, but that really kind of depends on the company, depends on the buyer. But, the process itself tends to be pretty standardized, which is we're going to engage with a client once they decide they're ready to sell, and we're going to start working on putting together some marketing materials. The terminology for that is a confidential information memorandum, which is a book of information about your business. It's an introduction, kind of dives into who you are, what you do, why you do it, how well you've done doing it, kind of that financial information. Some industry information as well, information about who's with the company, really just kind of a deep dive, but still fairly high level. We're not going to give them everything at this stage. We're also going to prepare a teaser, which is essentially a one-page de-identified version of that SIM or confidential information memorandum.
Now, the potential who you're teasing, they don't know the name of the company at this point.
That's right.
How do you find, and I want you to continue with the process, sorry to interrupt, but how do you find who you present the teaser to? And is that typically private equity, or it just depends on the company?
Depends on the company. Depends on what the seller wants, right? Because some seller, every seller is different and has different expectations for what they want the outcome of the transaction to be. We talk a lot about maximizing value, but when you've spent your entire career building a company, you're going to have some kind of non-quantifiable, intangible values that you have with that business. Right. It's your legacy in the community. Mm-hmm. It's your employees. You want to make sure that they're taken care of. So you've got to find a buyer whose values, not from a monetary standpoint, but their true values in the way that they approach operating a business align with yours. And so that's something that we always have to take into consideration. That might be a strategic, it might be your competitor who's looking to kind of grow and take you out of the marketplace, or it could be a private equity group.
Now the private equity groups, and I guess for a lot of folks out there that have no clue if we're talking about 100 or thousands and thousands, there's a lot out there. I'd like for you to hit on that, but then I assume they have a track record of some sort where you might know if they're a company that values, or, if the owner, let's just say, is ready to exit, or they had a bad life event and they need to exit the business. I would say it could happen sooner for a certain buyer that may not care as much about their values or employees as they do just the business. So when you send that teaser out, I know you're not just hitting one button and it goes to a bunch of people, and you put some thought into it, but I guess hit on who private equity is, and I'm assuming this is okay to say there's good ones and bad ones, and so for the seller, for me that would be very important. For some it might not be as important. Some of them it's just about the money, and I have a friend now that has great potential to sell his business, but it's more important for him to pass it on to his daughter. And I have friends that have passed the business down to their 2 sons. I would argue you could also sell it and give them the money, but that is a personal decision, and there's lots of options.
Yeah. So it's lucky if you have a child who wants to run your business. I think what we see a lot these days is you have parents who are looking at the next generation, and there's not a whole lot of interest in stepping in and running it. So it's if you have someone you can hand the business to, that's a very fortunate position to be in. As far as every private equity group, what we call financial buyer, is going to have its own strategy, its own approach. Most of them have limited partners, investors in the fund. Depending on the size, they might be university endowments, could be high net worth individuals, anyone who's just got some capital that they want to deploy into alternative investments.
They expect a good return.
And they expect a good return. On the other hand, you have some groups that are more family office backed. They might actually take a much longer time horizon because many LPs are going to be looking for some return in a 5 to 7 year window. And so the private equity groups are going to have to say, well, okay, we're going to make some investments, buy a platform, grow it, and then exit it within the next 5 to 7 years. There are others that say, we're going to buy and build this thing and we're going to hold it in perpetuity. And so those are different strategies that it's our job to understand who's going to be the right buyer. And we're going to bring those folks to the table. You mentioned the teaser, that's de-identified. We're going to send it to a group that our client, the seller, is going to agree upon, right? Because what our goal is to go out there, use our relationships and our resources to find a broad selection of potential buyers that we can bring to the table to make it as competitive as possible. And those can be strategics. Strategics are going to be, competitors, people that are businesses that are in your industry. Maybe it's a vertical or horizontal type transaction. And then there's financials with the private equity. So we're going to bring a broad list of those to our client, discuss those groups with them, and give them an opportunity to say, yeah, I want you to send it to them. I don't necessarily want you to send it to that group because either they know if we don't want them knowing the information that we're about to share, so let's just leave them out of the process. So we maximize optionality for our client within that process. But the benefit of that too is, if it all goes well, you're going to have an opportunity as the seller to hear from a lot of buyers with various strategies and approaches to running a business. And it's going to be your opportunity to decide who's the best one to go with. We don't necessarily want to go out there and just come back with one buyer. We want to give as much optionality as possible. So it's the seller, it's our client's determination at the end of the day to pick what group they want to go with.
Well, and by creating that competitive market, you can sometimes recognize a greater value for the seller as well. You mentioned horizontal and vertical, and we've said the word platform a couple of times. Talk about what that means.
Yeah, so in many cases, when we're talking about private equity, what they're trying to do is to go out and buy companies, fundamentally. And what they'll often do is acquire what they call a platform company. And the platform's going to be somewhat larger, a little ability to operate independently and then grow it. And then they'll go from there and say, we have an acquisitive strategy. We want to go out and find new companies to bolt on to this platform that we've just bought. And so they might say, we want to pursue an acquisition strategy that's going to get us into new geographic markets. Or maybe if you are in the home services space, you're going to say, well, we're really focused on plumbing, but we'd like to get into HVAC. So you're going to go out and maybe find an HVAC services company that's going to expand the options of services that you're able to provide your clients and hopefully increase the value and amount of money that you're able to get from those customer relationships. Those strategies vary from one group to the next, but there's a lot of different avenues that they can go down, from kind of the vertical to the horizontal. That is kind of thinking, okay, are we a manufacturer of a product and now let's say a fertilizer, but we want to get into the services space, the actual use of this. So you go and you buy a landscaping company that then uses that same fertilizer that you're manufacturing. So you're kind of able to build out a vertical strategy where you're both manufacturing the product, probably distributing it, and then actually applying it at the end market as well.
And what I've seen in our home service industry, and I see it a lot now with especially roofing right now, I think it would work for almost, and it probably does work for almost any part of the industry. I know it happens a lot with pest control. But if it's USA 123 company, and they're really sophisticated and have done a good job, and they have a decent sales margin, and their sales revenue is great. What you're saying is private equity would identify them as the platform, and then they would go acquire 100 or 200 other companies across half the United States that does what they do. And then and I know we're getting a little long-winded here, but I've got a lot of questions. When people say roll equity, let's say I was a company that USA 123 wanted to buy, my options to stay with the company and what a recap means.
Yeah, so rolling equity is an option, and this tends to really be important if you are, as a seller, someone that they want to keep involved and engaged with the business. It's also a way that they can kind of reduce the cash outlay at the time of transaction, so they're not actually putting quite as much money into the business on day one. But what it gives the seller the opportunity to do is to have what we tend to call a second bite at the apple. So you have a buyer at the table. They communicate what their strategy is going to be with the business, how they want to grow it. And that might sound fairly interesting to you as a seller to say, well, I'd put some equity. I'd be an investor in this project, this company that you're building. And so the rolled equity gives you an opportunity to do that. So within that 5 to 7 year period, when they exit, you will actually receive a return on that investment that you've rolled into that business. And it's not uncommon that second bite at the apple is actually larger than the initial value that you got when you sold your business the first time.
Well,
around.
And if you believe what you have, you're getting to invest, and now you have some money to invest, but you're investing just like the university or the teacher's endowment or the high net worth individual, and you get to play a part in what that profit and return can be. Before we wrap up, let's talk about, okay, somebody's interested and they want to have us come in and help on the sales side and advise them and look for a potential buyer. Once, we have our LOI and our teaser and they're ready to go, what's the process like and how difficult is that process for the seller? How much time are they going to put into it? Are they going to have to keep this a secret from everyone? And we don't have to sugarcoat it. It's not a piece of cake sometimes. So talk about the process of getting to the actual closing table.
Yeah, absolutely. So, we are going to set up a process based around the goals of our client. But fundamentally, what we're trying to do is to find the right buyer for your business and communicate the value as much as we can so that they're going to pay you as much as your company's worth, which we think tends to be a lot more than their first cut's going to be. This is why we negotiate. But the way that this works is we're going to have a 2-track process at the beginning. We're going to start putting together a list of buyers, and then we're going to start putting together marketing materials. The marketing materials are going to include the confidential information memorandum, which is kind of an overview of who you are, what you do, how you've done it, and how well you've done doing it as well. Then we'll have a teaser, which is a very short 1-page version of that. Doesn't tell the buyer who you are, and send that out to an agreed upon list of potential buyers. Once we've sent that out, we'll send it with an NDA. If they're interested, they'll send us an NDA. We'll send them that confidential information memorandum, which tells them, again, who you are now, so they know who the seller is. And we'll then enter into a negotiation process with them. They'll have some questions about the opportunity, maybe some additional requests. We'll try to fulfill that to the best of our abilities. And then about a month into that process, we're going to say, hey, you need to tell us, are you interested? And if you are, how interested are you? What are you going to be willing to pay for the company?
Right.
We'll hopefully get, 10 plus of those IOIs, as we call them.
People that are interested.
People that are interested.
They want to learn more.
They want to learn more, and they've told us, this is how much we think we'd be willing to pay based on what we know today. So then we'll have a conversation with you, the seller, to say, here's who we're talking to. Let's whittle this group down a little bit because we don't want to have you meeting with 10 different groups. Let's go down to 5. Sure. And so we'll look at valuation, we'll look at values, their background, who we think is going to be the best fit. And then we're going to continue to have some conversation with them, maybe a call between you and them as well, so you can kind of get to know them a little bit better. Mm-hmm. And then after a few weeks, we're going to say, okay, everybody, sharpen your pencils. We need your letter of intent, which is going to be that binding agreement where they say, this is what, knowing what we know today, based on the assumptions, the performance that you've told us, we're willing to pay you. And they'll say, we need X amount of time, typically 90 days, to diligence the company. And at which point, it's kind of open kimono time, right? Okay. We're giving them everything. They're looking through anything that they want to see. They're basically going to get a chance to see it.
Well, and to clarify for the sellers out there that haven't been through this process, they don't sign more than one LOI. So when you start that process, you've somewhat committed to that company, and you really can't talk to others, correct?
That's right. There are processes where, sometimes you can have multiple LOIs. We tend to prefer that an LOI is exclusive, right?
You've done your homework to know this is the buyer that I would prefer. And
that's right. So it's an exclusive agreement to move forward over an agreed upon period of time to ultimately get to a transaction. Okay. So we'll move forward with that one group. We'll again enter the diligence process, which they'll have attorneys, they'll have accountants who are kind of pouring through your books. Mm-hmm. If you own property, they're going to go out there and check to make sure you don't have any contaminants in the soil and make sure that the property they're buying isn't essentially a brownfield. So we're going to help navigate that whole process. Like I said, it can go 90 days. Sometimes, depending on what they find, it can go a little bit longer, to the point that we get to the closing of the transaction, the final negotiation of the purchase agreement. You'll also have attorneys on your team that we'll be working with. They'll have their attorneys that are trading drafts. And hopefully we can get to a closed transaction, like I said, within typically a 9-month period, although it can last a little bit longer, or it can go faster.
So V2 Strategy Advisors is a partner with Decosimo and Garnett and his team. What I like to do is help get the seller ready, and I get a lot of questions or emails or messages on social media about what can I be doing now. And when we feel like you're prepared, then we'll engage Garnett and his team to come in and follow that process. And I see so many things, and some of these are common sense. Some of them maybe not so much because the potential seller has not been exposed to it. But I mean, there's a value on their website. There's a value to their systems and to their employees and to what CRM they use and how good their financials are. And, I just, there's a lot of things that we like to look at ahead of time to know, are you 6 months from selling? And then V2 Strategy Advisors will be happy to work with you to get you ready. And then we'll engage Garnett and his team and hopefully bring a great value. And really, like Garnett said when we started, you only get one shot at this. And I think that's why it's crucial that you get it right, because you're changing not just your employees' lives and, for you and your family, potentially generations to come. So I think it's super important.
Well, it's what makes it so rewarding for us.
That wraps it up for today. We went a little long, but hopefully you got some value out of that. And there's just so much to share. We're going to be sharing a lot more in the future, so stay tuned.